It's a headline no American consumer, trucker, farmer, or manufacturer wanted to see. US diesel has broken above $5 per gallon for only the second time in history. The last time we saw this level was late 2022, in the chaos of the Ukraine war. Back then, the world was reeling from supply chain breakdowns, energy chaos, and the fastest inflation in a generation. Now, a new storm is here, and it is not being covered nearly enough by mainstream media. This isn't just a pump price spike. This is a second wave of cost-push inflation, one that rips through supply chains, lifts food prices, crushes manufacturing margins, and forces the Federal Reserve into an impossible corner: hike rates again, or hold them high forever and risk stagflation taking root in the American economy. Today, we break down exactly why diesel is exploding higher, how it directly hits your wallet and the official CPI inflation numbers, what the Federal Reserve can and cannot do, how financial markets are reacting, and whether we are sliding back to the painful 1970s-style stagflation that defined a generation. This is the full macro picture you won't get from nightly news, and it could change how you budget, invest, and plan for the rest of 2026. The diesel breakout. What just happened? Let's start with the hard numbers. As of March 16 to 17, 2026, the U.S. national average retail diesel price crossed $5.04 per gallon, according to GasBuddy and AAA data. To put that in perspective, that is a 34% jump in just a matter of weeks. A move that fast in such a critical commodity is extremely rare outside of a full-blown crisis. This explosive rally is being driven by two unforgiving forces that show no immediate sign of easing. First, Strait of Hormuz tensions and supply disruptions. Roughly 20% of global seaborne oil flows through this narrow choke point, and roughly 9% of global diesel shipments pass through the same channel. The latest geopolitical escalation has led major international carriers to suspend normal transits, reroute massive vessels all the way around the Cape of Good Hope, and effectively slash near-term global supply. Longer voyages mean higher costs, fewer deliveries, and tighter availability. At the same time, Middle Eastern refining capacity, a critical source of diesel for global markets, is under significant pressure. The result is not just a paper shortage or a futures market squeeze, it is a physical shortage of the fuel that runs the real economy. Second, ultra-tight inventories. Even before this latest geopolitical shock, U.S. distillate inventories, which include diesel and heating oil, were already stuck at 5-year lows. There was no buffer. No spare capacity to absorb a geopolitical hit. No extra supply sitting in tanks to calm the market. When supply suddenly collides with near-zero inventory, prices don't just rise gradually, they explode higher in a very short time. And make no mistake, this is not gasoline. Gasoline fuels drivers and personal vehicles. Diesel fuels civilization. It powers 18-wheelers, freight trains, shipping trucks, farm tractors, construction machinery, manufacturing equipment, ports, and cargo delivery systems. When diesel breaks out, everything gets more expensive, from the food you buy to the goods you order online to the materials used to build homes. This is not demand pull inflation from too much consumer spending. This is cost push inflation from the bottom up, and it is far harder for policymakers to fight. How diesel drives inflation. The full transmission chain of the world. Let's map exactly how $5 diesel becomes higher inflation, higher daily costs, and a lower standard of living for millions of Americans. This transmission chain is real, it's fast, and it affects every corner of the economy. Point 1, logistics and trucking. The first domino: trucking moves roughly 70% of all U.S. goods. Everything you touch, wear, eat, or use arrived at some point by truck. Diesel typically makes up 20 to 30% of a trucking fleet's total operating cost. Carriers do not absorb that hit, they cannot absorb it without going out of business. Instead, they pass it through with fuel surcharges that get added to every shipment. Retailers, distributors, wholesalers, and restaurants then pass those surcharges directly to you. Every pallet, every box, every item on the shelf carries an invisible diesel tax that you end up paying at checkout. If you think fuel costs only affect what you pay at the pump, you are missing 90% of the pain. Point 2. Agriculture and food. The silent price hike. We are currently in peak planting season for corn, soybeans, wheat, and other staples that feed the nation and the world. Farmers run tractors, harvesters, irrigation pumps, and drying equipment almost entirely on diesel. They also ship grain, livestock, dairy, and produce using diesel trucks. The American Farm Bureau has repeatedly warned that fuel and fertilizer costs are among the single biggest drivers of food inflation. A USDA estimate shows U.S. farmers spent nearly $10 billion on diesel in 2024, roughly 2% of total production expenses, and that number is now skyrocketing in real time. Higher diesel directly translates to higher grain prices, higher meat prices, higher dairy prices, and higher shelf prices at grocery stores. Food inflation, which had been cooling for months, is now about to reignite. That means your weekly grocery bill will go up not because you're buying more, but because the system delivering your food is getting more expensive by the day. 3. Manufacturing and industry. Margin squeeze. Modern manufacturing runs on diesel-powered equipment, material handling, and global supply chains. Steel, plastics, construction materials, autos, electronics, furniture, appliances, all rely on diesel for production, transportation, and distribution. When input costs jump sharply, factories face two terrible choices: raise prices and lose demand, or hold prices steady and crush profit margins. Either way, industrial activity slows. Hiring weakens, and inflation remains high. This is not a temporary blip. It is a structural pressure that works its way through every industrial sector. For CPI and inflation metrics, the second shock. Economists have studied this link for decades, and the numbers are clear. A 10% diesel price increase typically lifts headline CPI by 1.2 to 1.8% over the following 6 to 9 months. Core goods inflation is even more sensitive to energy input costs. The first inflation shock in 2021 to 2022 was driven by stimulus spending, broken supply chains, and energy chaos. The second shock, starting right now, is energy-led, supply-constrained, and much stickier. The Fed's preferred inflation gauge, core PCE, had been slowly creeping toward the 2% target. Now that hard-won progress is at serious risk, headline inflation will pop first, core inflation will follow with a lag. The idea that inflation was transitory, or already defeated, is dead again. Now the Fed's impossible dilemma: hike, hold, or cut. This is where the story gets brutal for policymakers. The Federal Reserve entered 2026 hoping to pause rate hikes, let inflation cool gradually, and then begin cutting rates later in the year. The economy was clearly slowing. Q for 2025 GDP was revised sharply lower to just 0.7% annualized. The labor market was softening. Markets priced in 1 or even 2 rate cuts in 2026. Diesel above $5 changes everything. The Fed now faces a triple mandate nightmare. Inflation is rebounding, driven by energy-led cost push. Pressure growth is already weak, running at stall speed. GDP. The labor market is softening but not collapsing. Let's lay out the Fed's 3 terrible options. None are good. Option 1. Hike rates again. If the Fed hikes rates again to crush inflation expectations, it risks pushing the U.S. directly into a recession. Higher rates already crush housing, autos, business investment, and refinancing activity. Another hike now would be politically toxic and economically painful for millions of households. But if inflation expectations become unanchored, like they did in the 1970s, the Fed will eventually be forced to act anyway, even if it breaks the economy. Option 2. Hold rates high forever. This is the higher for longer nightmare scenario. The Fed holds the federal funds rate at 3.50% to 3.75% through all of 2026 and deep into 2027. This keeps borrowing costs extremely punitive for households and businesses. It slows growth but does not fully kill inflation, because this is supply-driven inflation, not demand-driven. Monetary policy cannot drill more oil, cannot reopen the Strait of Hormuz, cannot refill empty diesel inventories, and cannot fix broken logistics chains. The result is simple: stagnant growth plus persistent inflation equals stagflation. Option 3. Cut rates anyway. If the Fed cuts rates early to support growth and markets, it risks unleashing unanchored inflation expectations. Markets will price in permanently higher inflation. The dollar weakens, import prices rise, and energy-driven. Inflation becomes embedded in wages and prices across the economy. The 2% inflation target becomes a distant memory. This is exactly the mistake policymakers made in the 1970s. They let inflation become structural, and it took a brutal recession under Paul Volcker to fix it. The Fed's current path is now forced: hold rates steady and delay rate cuts as far into the future as possible. Market expectations have shifted dramatically. The first rate cut is now priced for September 2026 at the earliest, and many Wall Street banks now say cuts could be pushed all the way to 2027. Fed Chair Jerome Powell and other officials have repeatedly said they are data dependent. But the data just flipped in a brutal way: inflation going up, growth going down. The Fed is trapped. There is no good choice. What is the market reactions? Who wins? Who loses? Markets are already pricing this new macro regime. Let's break down the clear winners and losers. Winners: energy and commodities. Refiners: diesel crack spreads explode higher. Refining margins surge when crude is strong and distillate supplies are tight. Oil producers, U.S. shale, integrated oil majors, and exploration firms all benefit directly from higher crude and product prices. Industrial commodities, copper, steel, and energy-related materials get a lift from reflation fears and ongoing infrastructure spending. Losers: rate-sensitive and consumer discretionary tech and growth stocks. Higher for longer rates crush discount rates and equity valuations. Especially for unprofitable or long-duration growth companies, housing and autos, mortgage rates and loan costs stay elevated, crushing demand for big-ticket purchases. Retail and restaurants: margin compression from transport costs plus weaker consumer spending equals significant earnings pain. Bonds: treasury yields face upward pressure as inflation rebounds. Fixed income assets suffer price declines. On the currency side, the US dollar will stay supported by rate differential hopes, at least in the short term. But if stagflation takes hold, safe haven demand will compete with inflation fears, creating volatility. Emerging markets face a double whammy: higher energy costs plus stronger US dollar plus tighter American monetary policy. Are we back to the 1970s? 26:00, 33:00, the S word is everywhere right now: stagflation. But is this really a full 1970s replay? Let's compare honestly similarities to the 1970s energy supply shock. 1970s had OPEC embargoes, 2026 has Hormuz tensions and diesel shortages, sticky inflation, price pressures become embedded after years of loose fiscal and monetary policy. Fed dilemma: slow growth plus high inflation leaves policymakers paralyzed, cost of living crisis, wages fail to keep up with rising prices for everyday goods, critical differences today. U.S. Energy independence: the U.S. is now the world's top oil producer, not a helpless importer at the mercy of OPEC. Fed credibility: the Volcker-era legacy means the Fed will fight much harder to prevent unanchored inflation. Lower energy intensity: the U.S. economy uses far less energy per dollar of GDP than in the 1970s. Inflation levels: 1970s CPI peaked above 13%. Today's CPI is around 2.4–3.0%, still far lower. The honest verdict: we face stagflation risk, not stagflation certainty. This is more likely a soft stagflation or stagflation-like scenario: low growth, sticky inflation, and no easy policy exit. It won't be the 1970s nightmare, but it will feel like a long, grinding grind of high prices and slow economic progress. What comes next? The next 3 to 6 months will define this economic cycle. These are the catalysts you must watch: Strait of Hormuz de-escalation: any diplomatic breakthrough will ease supply fears and pull diesel lower quickly. Diesel inventories: if U.S. distillate stocks begin to rebuild, price pressure will fade. If stocks stay low, $5 diesel becomes the floor, not the ceiling. CPI and PCE prints: April and May inflation data will tell the Fed and the markets whether this is a temporary spike or a sustained second wave. Fed. Plot and SEP: the March-June FOMC meetings will almost certainly revise growth and inflation forecasts higher, and rate cut expectations lower. Agriculture pressure: spring planting costs will directly feed into summer food inflation numbers. Our base case: diesel stays above $4.50 to $5 for months. Inflation rebounds. The Fed holds rates steady through 2026. Growth stays weak but avoids a deep recession. Stagflation risks remain elevated. What this means for you, a consumer and investor playbook. Let's make this personal. This is not just macro theory, it directly affects your life. For consumers, expect higher food, fuel, and goods prices through 2026. Transport costs will rise, delivery fees, shipping costs, travel expenses, and logistics surcharges all go up. Real wages could turn negative again as inflation outpaces pay growth. Avoid variable rate debt, mortgages, credit cards, personal loans, and HELOCs will stay expensive. Build a small buffer, unexpected costs are coming, and safety margins matter. 4. Investors overweight energy, refiners, and commodity equities. They are the most direct hedge against energy-led inflation. Underweight rate-sensitive tech, housing, and consumer discretionary. These sectors face strong headwinds. Hold real assets, gold, commodities, and infrastructure act as classic inflation hedges. Beware long-duration bonds. If yields rise further, bond prices will fall. Stay flexible. The next 6 months could bring extreme volatility as the Fed reacts to incoming data. And now, the second inflation shock is just around corner. Let's wrap this up with absolute clarity. U.S. Diesel above $5 per gallon is not a one-day headline. It is not a temporary blip. It is the start of a second inflation shock, one that is supply-driven, systemic, and largely out of the Fed's immediate control. The era of cooling inflation is paused. The era of energy-driven cost-push inflation has returned. The Fed is trapped. The consumer is squeezed. The market is at a crossroads. This is the macro story that will define 2026.